Here's one thing that most homeowners have, but it's very rare that they understand how it works from start to finish. I'm Rebecca, the Mortgage Mentor, and I'm licensed in dozens of states and for many years. I'm here to help mortgages make sense, so be sure to subscribe and comment with any questions you have. Most mortgages require an escrow account, and your escrow account is going to be a separate savings account that's attached to your mortgage. It's not something that you keep, but it's something that your lender holds on to. And what happens is every month you pay a portion of your property taxes and your homeowner's insurance into that escrow account. The reason that some programs require it regardless of down payment, and the reason that other programs may incentivize you with slightly better terms to have an escrow account, is from a lender's perspective, there's less risk. If they know that they are collecting enough to pay taxes and to pay insurance, there won't be a tax lien, and also the property, which counterbalances the loan, will have sufficient insurance to cover it in case there's ever loss. There are two main aspects that are misunderstood. The first is what gets collected for at closing and how those calculations are made. So because the first year's insurance premium is going to be collected at closing, right from the beginning you have 12 months of insurance that will be paid for through your closing costs. This is to make sure that the policy starts the first day that you own the home, the day of closing, and then it will carry you through until a year later. What happens when you start making payments is you will pay a 12th of that insurance bill into the escrow account to build that escrow account up. So next year when the policy renews, it will be paid from that account. What's also collected for insurance is going to be a 3-month cushion. This is because typically insurance and taxes do go up. And so the lender wants to make sure that there's enough in that account to pay the bill when it's due, and then there's a recalculation of how much will be needed for the next year. For your taxes, you will also have a 3-month cushion. But as far as how many months get collected will depend on your state, the type of transaction you're doing, whether it's a purchase or a refinance, and also based off of when your state's taxes are paid. Some taxes are paid annually, some are semi-annually, and depending on when that tax bill is due, that factors into how many months reserves need to be collected for your escrow account. Now, let's say that you're closing in the middle of the year. You will probably have around 9 months of taxes collected because that tax bill is going to come due most of the time in the fourth quarter. But you haven't owned the home for a year. So what you will see is although there will be 9 months of taxes collected, and that what goes into the escrow account to make sure that there's enough to pay the bill, what you will see is a prorated credit from the seller from January 1st through the day that you close. That way they've paid you for their portion from the beginning of the year through closing, and then you pick up the bill afterwards. The second thing that gets misunderstood is the impact of escrows to your payment. And this is why before going under contract, it's so important to discuss with your lender the address of the home that you're interested in. That way we can look up property taxes or make an informed decision. And also depending on where a property is and the type of property it is, there may be extra insurance that's included. So because those escrow accounts are factored into your payment, it can affect your qualification. If a property has higher taxes or higher insurance, that may mean that it disqualifies you from purchasing that property. And that's information that you're going to want to know before going under contract. The other thing around how escrows impact your payment is what happens when that tax bill or that insurance bill comes out and it's higher. The lender is going to go ahead and pay that bill to make sure that insurance coverage continues and that property taxes are paid. However, each year once those bills are paid, you will get what is called an escrow analysis. And that escrow analysis says, here's how much we've collected, here's how much we've paid out, and here's where the difference is. If that account is short, you will be offered two options. One, to make a lump sum payment to catch the account up what the shortage was, or to spread that shortage over additional future payments. Also, if the account was short because tax bills or insurance bills had come in higher, you will get a recalculated mortgage payment. That will be the case even if you have a fixed rate, because the loan portion of your payment does stay the same, but that escrow portion will vary depending on how much is needed. If you get that escrow analysis and you disagree, still make your payments, because if you make that payment short, your lender will count you late. So although it's inconvenient, still go ahead and continue to make the payments as calculated and dispute the tax bill differences or the insurance differences with the mortgage company, you can get a refund later, but you don't want a missed payment to hit your credit. So there are 3 things to look out for when it comes to escrow accounts: how it impacts your payment, how it impacts what you qualify for, and how much you need to bring to closing. I'm Rebecca, the Mortgage Mentor. I'm here to answer any questions that you have. So please let me know in the comments and be sure to subscribe.